the next is going to be technical analysis and fundamental securities analysis. And I break them up. There's technical analysis and fundamental securities analysis. In both cases, you can create systems to be able to trade the securities based off the technical analyses. You can build systems to be able to value the securities in a continuous basis. That's the beauty of the financial analytics and the data analytics and big data and data processing these days, is you can build these systems, and these systems are being built. They are built. They are being used and upgraded and built. Okay? The beauty of our industry, the finance industry, is that we have a lot of data, a ton of data, going back, a very long period of time. The question is, do you know how to use the data? Do you know how to build the IT platforms? Can you build the software applications? Can you utilize them? Can you build the tracking systems and the signaling systems to create the dashboards to be able to get alerted to either opportunities and risks that may be confronting your company, and then be able to react and act decisively, knowing that you're making the right decisions? Okay, so technical analysis first. And again, technical analysis is just the price over time. The level of the price over time, that's it, in a chart, in a graph. And the technical analysts believe that the markets are highly inefficient, and that they can look at pricing patterns to be able to identify opportunities to buy and sell securities, trade, and create arbitrage directly from the pricing graphs. Okay, so it is a violation of the efficient market hypothesis, the weak form. The weak form basically says that all information is embedded in the price, that there are no opportunities to arbitrage the price unless you have proprietary and insider information. And actually, even the semi-strong and strong form of the efficient market hypothesis states that even if you have that information, markets are efficient and you cannot arbitrage the price through trading. But the technical analysts say, no, that's not correct. I can trade off the patterns of the prices and identify opportunities to trade and make money. So the markets are in violation of the weak form in the efficient market hypothesis. So it's mostly momentum. So prices are highly autocorrelated. Okay? The prior period's price is highly correlated to the current period price. And if the price has been going up over time, it's highly probable it will continue to go up. If the price is going down in a trend, it is highly correlated to the prior prices, and the future price is probably going to go down because the prior prices went down. It's serial correlation. It's correlation by time, based on momentum. Historical analysis, you have to go back in time far enough to be able to identify the pricing patterns. Some people do day trading. Some people go back a month, 4 months, 6 months, 1 year, 5 years, 10 years to look for pricing patterns, to be able to identify opportunities to buy and sell whatever it is they're trading within a historical context. So you have to be able to recognize patterns within the charts. And again, a lot of this is all automated. If you read Flash Boys and you read what's going on in Wall Street and what they've been doing over the last 30 years, is they've been basically building technical trading systems to be able to utilize this information for pattern recognition to get in and out of the markets to create arbitrage profit through just building trading systems. So pattern recognition is one. It's time series analysis. You might even want to apply time series regression techniques in here to soup up and increase the precision and the performance of your trading system. Also, trading volume. Usually the pricing chart is up here, and then you have volume down here. You can see that when prices start to move, the volume increases. When prices start to fall significantly, volume increases. On the way up, there's buying momentum. On the way down, there's selling momentum. So you can combine the price charts and the volume charts too. And I think it was the MACD is the volume indicator that's actually tracking volume. and maybe volume starts to peak up first before it hits the price. So if you're monitoring the volume in these securities, it may be a leading indicator from price. It will signal you down here. You will take your position and you will be able to arbitrage your position. You can also use moving average crossovers. I didn't use that, but you can take a 52-week moving average. You can take a 60-day moving average, and you can use a 10-day moving average. Between those three, the 52-week is basically a drift or a trend line. The 60-day moves in a cyclical fashion, and the 10-day moves up and down, above and below the trend line more often. When the 52, you got the 52-day moving average, the 10-day crosses first, signal 1, and then when the 60-day crosses the 52, signal 2, you sell. In the buy scenario, the 10-day crosses the 52, then the 60-day crosses the 52-day moving average. Boom, you got signal 1, signal 2 for a buy. So moving average crossovers are trading systems that are developed just based on the pricing data.
And that's typically what's used.
The pattern recognition, and I'll go through some of the technical terms and the technical aspects, but it's usually momentum, trading volume, moving average crossovers, and then there are called wedges, where the pricing looks like it's getting more volatile. So it's called a wedge or a flag. If you want to learn about technical analysis, the technical securities analysts out of San Francisco have a lot of research. Golden Gate has a whole certification in it. A lot of the major traders in downtown San Francisco are certified. They lecture, they teach. It's all on this stuff. I actually like to combine these two because I think it's more powerful. Okay, did that answer your question?
Yeah. Are we going to be going into more detail about
probably
this
not.
section?
If you want me to go into more detail, I will refresh my technical securities analysis. But this is basically a high-level overview. Okay, but I'm just bringing it up because, you know, in financial analytics, in big data, a lot of the trading platforms from the hedge funds and the broker-dealers and the investment banks used to do a lot of this. They built these systems, quantitative systems, using big data analytics, financial analytics, to be able to build these trading systems based on the technical analyses.
Yeah.
Okay, and there's quantitative modeling underneath this.
And where does Black-Scholes sit in all that?
The Black-Scholes is over here in option pricing. Okay, but you can price the options using Black-Scholes, using the data coming off the system. And if you think that the option value based on Black-Scholes is higher than what you can buy it at today, then you're going to buy it, right? So the Black-Scholes model and the binomial tree model are models that you use to value options, okay? And if you got the system in place to calculate the option values and you have the current price data of those options, if the price of the option is less than what you're valuing it at, you're going to buy it, right? Because eventually the data is going to hit and it's going to revert to the true intrinsic value. If all of a sudden you run it and the option value is below what you can currently sell at, then you're going to sell it or you're going to sell it short, because eventually the option value is going to approach the intrinsic value. And that's because we all in this discipline believe in efficient markets. Efficient markets is the underlying assumption. The market will eventually revert to the true intrinsic value of the asset over time as more information comes. You may just be privy to information because you do a better job of collecting the data, processing the data, and you have better trading systems, and you have really smart people, and you have a lot of capital. You can arbitrage with those comparative advantages.
So it looks like everybody talks about the Black-Scholes model.
Yeah, that's the
value.
value.
Price options. So my question is, if, for example, he uses the Black-Scholes model on the same stock, and I use the same Black-Scholes model on the same stock, are we going to come up with the same price, or is it because of enough variable that make the price.
Yeah, I mean, he may be using a data set that's different than yours. He may be forecasting interest rates different than you are. You know, there's the variables may be different, so you're gonna come up with two different approaches. If you have better data and you're smarter at understanding the data and you're better at forecasting interest rates and those things, you have maybe a nice time series that's normally distributed without a lot of outliers and noise and disruptions, he may be able to do a better job of predicting. And that's why the markets are so competitive. And it's really hard to arbitrage. If there's any arbitrage opportunity in the marketplace, usually it's for a small period of time and then it gets arbitraged away. So that's why they are constantly analyzing the data, putting it through the systems in continuous time, trying to identify minute arbitrage opportunities, because you can make a lot of money if you can spot those price discrepancies. Okay, let's continue to do this. So here's a price pattern. It could be a stock, it could be an index, it could be oil, it could be gold, it could be anything. Usually the price patterns are relatively the same. There's white or randomness associated with the prices. They move in patterns, but there's some volatility around the movements. As you can see, there's a trend line up here. There's a trend line this way. The prices moved up. They broke through. In this case, this is if we were just looking at this. If I had pricing supports like this going back in time, right? Because you can see it hit the support here, hit the support here, hit the support here. So this is called the support line. Okay, and let's say this extended back, and it looked like it had bounced off this line. Well, when it broke above the line, that's called a breakout. So the prices broke out above their. This would have been the resistance line. When it broke out, it looked like it hit the support. As it traded over time, it looked like it traded within a range. It's called the trading range. It is the accumulation phase, okay, in which there is no definitive direction in which the price is going because there's no new information. The market is basically waiting for new information to hit because the price encompasses all information in all variables. The price is the dependent variable, and then you have independent variables that drive the price. So as you can see, it traded in a range, it hit the support, and then it started to move up, and it broke out. So it hit the support line, here was the resistance line that it tested here, and then it broke out here above the resistance line, and it looked like it might have been forming another support here, but it didn't. It kept going up. It peaked out. That became the resistance line. It looked like it broke down below its support. It came back up. It tested it. And it looks like that becomes the resistance line. And then it moved down into a downward trend. It hit the support, moved up again, and then broke through the long-term support line, broke to the downside, and looked like it continued to go. This is like oil. If you look at oil prices, this is basically starting in 2000. Right here was highly volatile, peaked at about 09 through 9 and 10 at 106, traded like this at 96. Then we were in like 35 to 45. Now we're below 30, and it looks like $20 could be the structural support line in which oil could settle. But if it breaks through 20, I don't know how far low oil can go. But the assumption is that this pricing pattern, this trend for the price of oil is over, okay? And that the oil will probably trade within a range for decades because of fracking and Iran, and if you look at the economic fundamentals of oil, it looks like it will trade probably between maybe $15 and $25 for 10 to 15 years potentially.
You need 20 or 30 years of data for that.
What?
You need 20, 30 years of data for price.
Yeah, you can go back. And then I risk adjusted it too. I mean, the other day we calculated what the real value of oil based on inflation adjusted, and you're getting into the teens. Okay, so that's just an application. So you have to really set the supports, set the resistance lines, look at the pricing patterns, look at the breakouts, look at the volume, look at the trends, look at the momentum. And then you couple in the fundamental analysis over here to then place your trades. And put those in to your system as rules. Okay, they're rules. If it reaches this, we're gonna sell. If it goes down and then hits this again, we're gonna hold. If it hits here and starts to trend down, and we got our moving averages here, we're gonna probably sell here. If it hits these supports again, we're probably gonna buy because it's probably gonna pop. If I get a 10% increase in the price, I'm gonna sell it because I don't need any more return. And then if it breaks through here, it basically signals a long short position, and I might end up buying some puts or writing some calls here. And then just trading the momentum.
Sorry, thanks for getting us
Yeah.
a snapshot on how to read through this.
Mm-hmm.
My question is that, onto this analysis, well, how is the system automatically come up with all of these lines that, what we're reading off on? Is that something that, analysis actually go into with some input to come up with this bottom line, shifting peak line?
Yeah.
Or are we
Yeah.
supposed to, have some languages into the system so to make it work to come up with this?
Yeah, you will
so
be
that I can
putting
read
it-
off to it?
Yeah, I mean, ideally, your system that you develop is a learning system, right? It's going to be able to identify and confirm the supports and the resistance, the trending. It should be rules based.
So is that
Should
like
be
the
rules.
R system
There's
that
no
we've been
software.
having books about, or
There are
what
software
they call it?
applications. A lot of the applications are proprietary applications.
Right.
The applications that you're using are open source, which will probably be complementary to the proprietary systems.
Okay.
Okay, so what we're learning is basically augmented applications, probably around a proprietary system. And the proprietary systems are systems of systems, right? They're independent systems of systems. So the people who design these things are really systems designers, and then you have the engineers, that are basically stress testing it, designing it. And then you got the data scientists, then you got the application people, then you got the traders, and then it all feeds back, right, into the system, so it's a learning system.
So with technical analysis, you often hear about Fibonacci retracement.
Yeah, I did talk about Wyckoff methods and stuff like that. Yeah, so that the Fibonacci retracement, just like the Wyckoff method, is just another series, and the Dow theory are the series of technical analytics that you would apply to these to be able to come up with your view and your trading, what you're going to do. And you would rules base it. Okay, you try to eliminate the emotion from it, you program it, you rules base it, and if the system is telling you to sell, you sell. If it's telling you to buy, you buy. You don't use your emotional gut feel, because you have lots of data, and you have tried and tested technicals, and you have lots of data, which is normally distributed, so your statistics and your approximations are fairly accurate. And that's in technical analysis is just a whole nother science, but it's totally applicable to what you're learning, because there's direct applications going on in a multi-trillion-dollar industry that trades trillions of dollars a day. And actually, the technical analyses I use a lot when I just do analysis. If I'm looking at PE ratios for my firm, or I'm looking at employment counts or costs or pricing, I'm looking for trends in the data. Is the trend in the data, is the pricing patterns, are the patterns consistent with the behavior of whatever it is I'm tracking or trying to measure? Is it starting to do something weird? If it is, I better figure it out, because it's either bad data or something has changed in the market. So I use technical analysis all the time, pretty much for everything that I look at, because I'm looking at trends. And it comes in handy for budgeting too. Any other questions? That's just the primer. Okay, so fundamental analysis is different. You're basically you're trying to determine intrinsic values for the securities. In this case, we're just going to be doing stock, okay? And if I calculate the intrinsic value using the different methodologies, and the intrinsic value is higher than the current stock price, I'm gonna buy it, because the market's efficient, will internalize the information, and the stock price will go up, okay? But I bought it lower than it otherwise was. So if I'm getting high intrinsic values, I'm gonna buy it low, and then the price is gonna go up, and I made the money. If I calculate the intrinsic value, and it's below the current stock price, I'm gonna sell it, okay? Because why would I lose money? And again, if I think the prices are gonna go up, I can buy it, or I can buy call options, or I can write put options. If I think the prices are gonna go down based on the intrinsic valuations, I can sell it short, buy puts, or write calls. So the intrinsic valuations is another approach, other than the pricing patterns, to come up with the intrinsic values. And in this case, it's stock. First variable is gonna be the cash flow per share. Could be free cash flow, EBIT or EBITDA, earnings before interest, taxes, depreciation, amortization. Could be net operating income, could be earnings per share. It depends on what numerator you use based on what you're trying to analyze. So you have cash flow, and there's gonna be cash flow growth rates too. Cash flow 1 year in the future, or cash flows that are gonna grow into perpetuity. So cash flow is one of the most important factors. The other is cost of capital, or the discount rate. What is the discount rate? That's a big question. What is the discount rate in which you're gonna discount these cash flows at? Well, first, the discount rate is your required rate of return. Okay, I require a 14% rate of return on my stock investment. 0.14 is what you're gonna apply to the numerator. Okay? Or it's gonna be your weighted average cost of capital. What is my cost of debt? What is my cost of equity? How much debt do I have? How much equity do I have? Let's calculate the weighted average. That becomes the discount rate in which you're gonna use to discount the cash flows. If I'm discounting a bond, trying to find the value of a bond, well, if I know the numerator, then I divide it by the cost of the debt, I get the value of the bond. If I know the dividends, and I divide it by the cost of the equity, I get the value of the stock. So it depends on, the numerator is determined by what you're trying to value. The denominator is what you're gonna apply to get the value that's appropriate for what you're trying to value, okay? So your cost of debt, and I'll go over it later, is gonna be the risk-free rate, which we talked about, which is the real rate plus inflation expectations, plus risk premiums. You start tacking them on. Risk premiums are illiquidity. My bond doesn't trade very much, so it's highly illiquid. Maturity, most of my bonds are very long dated, so they're very risky. I have to tack on illiquidity risk premium. I'm not a muni bond, so basically I may be subjected to tax changes in the future, so I have to add a tax risk premium. My firm is also subjected, we generate a lot of our revenues from overseas, so I should tack on a currency risk premium on top of it. So it's the risk-free rate plus these risk premiums, but then you add up, that then determines the cost of the debt, okay? When you calculate the cost of the equity, the appropriate methodology is to use the capital asset pricing model, or what is called CAPM. CAPM is also the risk-free rate plus the beta times the return on the market minus the risk-free rate. The return on the market minus the risk-free rate is called the market risk premium. The beta times the market risk premium is called the market price of risk. You add the market price of risk to the risk-free rate is going to determine the cost of the equity. Well, if you know the cost of the debt, and you know the cost of the equity, and you know the book or the market value of the debt, and you know the book or the market value of the debt and the equity, you can divide that into to get the ratio or the weight in which you will apply to the cost of the debt. You know the book value of the equity, and you know, or the market value of the equity, and you know the book value of the debt, and or the equity or the market value. You divide the market value of the equity by the market value of the debt and the equity to get the ratio or the weight for the equity. You times the weight of the equity, times the cost, the weight of the debt, times the cost of the debt. You add them together, you're going to get the weighted average cost of capital, and that is going to be the discount rate in which you are going to apply to the cash flows to calculate the present value of those cash flows, or the net present value, or the internal rate of return. And I'll get into that a little bit later too. So that is basically how you come up with the discount rate. Well, once you get the discount rate, you can put it into the perpetuity model. If you know what the cash flows per share are, next period, divided by the weighted average cost of capital, or the discount rate, or the expected rate of return, you are going to get the value of that security. So if this goes up, that goes down. If that goes down, this goes up. That goes up, this goes up, that goes down, that goes down. Laws of financial economics. Then you have the Gordon growth model that basically states that the cash flow is going to grow at a rate forever into perpetuity. So the equation decomposes down to the cash flow per share, the discount rate minus the growth rate. Well, to get the value using the Gordon growth model. So if G goes up, value goes up. If G goes down, values go down. If the discount rate goes up, the value goes down. If the discount rate goes down, the value goes up. That's the law of financial economics in the intrinsic valuation using fundamental securities analysis. There is the PE, or the multiple approach. You have the multiple, which is the price divided by the earnings per share. Forward looking, okay? Price divided by earnings per share, or EBIT or EBITDA or free cash flow, it doesn't matter, but let's just say earnings per share, you're gonna get a multiple, a cash flow multiple. You apply that cash flow multiple to the forward looking earnings per share. This is how you value securities, stocks. So you have some forward looking multiple, you have some estimated earnings per share, you multiply the multiple times the earnings per share, you're going to get the value of the security using the multiple approach. So if the multiple goes up, the value goes up. If the multiple goes down, the value goes down. If earnings per share go up, values go up. If earnings per share goes down, the value goes down. Very simplistic, elegant model. The investment bankers love it because it's easy. Discounted cash flow is the fourth methodology. The investment bankers and the security analysts use the multiple approach and the discounted cash flow approach as the main methodologies for calculating intrinsic value for securities. The discounted cash flow model, this is a 3-year holding period. So I have a cash flow in the first year. It's basically last year's cash flow. Then I grew it out to this year, and I put it in year 1. And then what I'm going to do is I'm going to grow out the cash flows over the next 3 periods, okay? Because I'm assuming that earnings are going to grow into the future. I've already calculated the weighted average cost of capital, so I know the discount rate. Or I can use, again, the expected rate of return that I want on that investment could be the discount rate. I could use that one too. So then you have, to discount these cash flows, you have 1 plus I, which is the discount rate. So if it's 10%, it's going to be 1.1, all right, to the 1 power, because it's in the first period. The second cash flow I grew out, it's going to be discounted by 1.1 to the 2nd power. Okay, I'm going to calculate the discount factor to discount that cash flow. Okay, in the 3rd period, I'm going to grow out the cash flow 1 more year, and I'm going to divide it by 1.1 to the 3rd power to get the discount factor that I'm going to use to divide up into that 3rd year cash flow to get the discounted cash flow. That's what we're trying to do. The key is in the 3rd year, not only do I get the cash flow, but I'm also going to sell the security. So I'm going to get the terminal value, or the sales price for that security in that year. So in the 3rd year, I get not only cash flow, but I also get the terminal value, the sale proceeds. I'm going to discount those back, and I'm going to get a net present value, or an intrinsic value for that security using the discounted cash flow, or the DCF methodology. Okay? So these 4 intrinsic valuation methodologies determine intrinsic values. And if the intrinsic values are higher than the current price, you buy it. You buy it on margin. You buy call options, and you write put options. If the If the price is below, or the intrinsic value is below the current price, then you are gonna sell the security, you're gonna sell it short, you're gonna buy puts, and you're gonna write calls. That's the intrinsic valuation, that's the trading methodology. Does anybody have any questions on that? Because we'll get into that a little bit more, because I don't know people's backgrounds and comfortableness in regards to discounted cash flows. Is everybody comfortable with discounted cash flows?
No.
Is this review? No, okay. Because these methodologies you can program in your data analytics platforms to do basically projections on distributions using simulation to come up with cash flow projections and simulated cash flow projections. You can come up with growth rate projections and discount rate projections and run basically simulation to come up with mean estimates of valuations and use confidence intervals to look at the valuation ranges in which the valuations could probabilistically be inside the ranges. Okay, so I'm gonna take a break. Let's take a 10-minute break and then we'll move through this. Thank you very much for your help. If you have any questions, let me know.
Sorry.